So, if you go back to the year 1623, there's this group of Dutch settlers, right? And they buy the island of Manhattan from the Native Americans.
Right, the famous $23 transaction.
Exactly. The price was roughly 23 bucks. And I mean, for centuries, history books, financial commentators, everyone basically points to this as like the ultimate cautionary tale.
Yeah, it's framed as the worst trade ever made.
Right. We're taught to look at that $23 and just think, oh, what a tragic scam. But if you actually run the numbers, like if you completely strip away the historical narrative and just apply the raw, unfeeling math of finance, you arrive at this conclusion that just shatters everything we think we understand about wealth.
It really does. It completely flips the script.
Because, think about it, if the Native Americans had taken that $23 and, say, handed it to a moderately competent trust officer, right? And that officer invested it at a completely boring average return of just 7% a year.
Just a standard 7%.
Yeah.
Nothing crazy.
Yeah, nothing crazy. Well, that $23 wouldn't just buy Manhattan back today. It would be worth $23 trillion.
Which is just, it's a number that's almost impossible to wrap your head around.
It is. I mean, to put that in perspective for you listening, the entire wealth of the modern United States, so we're talking every building, every corporation, every bank account combined, is around $150 trillion.
So that single $23 investment would effectively own a massive, meaningful percentage of the entire globe.
Exactly. And so today we are doing a deep dive into the source material that dismantles all these illusions you've been sold about how money is actually made, kept, and multiplied.
Because the foundational lie that society tells us is that massive reward requires massive risk.
Right.
We are constantly force-fed this really dramatic narrative.
Yeah.
You know, the visionary entrepreneur who mortgages their house, maxes out all their credit cards, and just risks total financial ruin for like a tiny chance at building an empire.
Yeah, we totally glorify the free fall. We love the dramatic struggle.
We really do.
Yeah.
But when you study the actual playbooks of the ultra-wealthy, you realize that narrative is a trap. It's basically designed to keep the working class right where they are.
Wow.
Yeah. The people who actually build generational wealth, they operate on a completely different frequency. Their entire philosophy is engineered around eliminating risk entirely.
Which sounds counterintuitive, but if you are listening to this right now, whether you're stuck in traffic on your way to a corporate job, or maybe you're staring at a business plan on your kitchen table, we are going to fundamentally rewrite your operating system today.
Absolutely.
Because we are pulling directly from the masterclass frameworks of Mohnish Pabrai. He's this legendary investor, manages over $1 billion. But, I mean, more importantly, he is essentially a forensic accountant of success.
That's a great way to put it.
Mm-hmm.
He really is.
He's reverse engineered the precise mechanics of how self-made billionaires actually operate.
And Pabrai distills this entire philosophy into a single unbreakable mantra, which is, heads I win, tails I don't lose much.
Heads I win, tails I don't lose much.
Exactly. That is the governing law of gravity for this entire discussion. Every single framework, every strategy, every billionaire we analyze today, they adhere strictly to that rule.
So if a venture has, like, a realistic possibility of wiping you out,
you simply do not participate, period.
Okay, but see, that sounds great on a bumper sticker. You know, don't take risks, but business is inherently risky. You need capital, you need a product, you have competitors.
Right, right.
I mean, you can't generate a massive return without putting something substantial on the line. The math just doesn't compute for me.
Well, to understand the math, we actually have to travel back to the 1970s and examine a Gujarati concept called Dhandho.
Okay, Dhandho.
Yeah, Gujarat is a state in western India. And culturally, the word Dhandho translates roughly to endeavors that create wealth.
Got it.
But in practice, it's a hyper-specific methodology of structuring a business where the downside is mathematically capped at near zero, while the upside is virtually infinite.
Infinite upside, zero downside. It sounds like magic.
It does, but Pabrai points to this extraordinary historical case study of the Patels to prove exactly how this mechanism functions in the real world.
Ah, the Patel Motel story. The historical context here is so critical because it forces the ultimate constraint, right? They didn't start with some massive venture capital check.
No, quite the opposite. I mean, the Patels were an ethnic group originally from India who migrated to Uganda, right?
Yeah.
To help construct the East African railway systems.
Okay.
And over a century, By applying these exact Dhandho principles, they built massive commercial success. They essentially controlled significant portions of the Ugandan economy.
But then things changed.
Drastically.
Yeah.
The geopolitical landscape violently shifted. Idi Amin seized power in the early 1970s, initiated this brutal nationalization program, and just expelled the Patels.
Just kick them out.
Stripped them of all their assets, their businesses, their homes. They were rendered stateless refugees literally overnight.
So a total wipeout, like the ultimate reset button just forced upon them.
Exactly. They fled primarily to North America, so the U.S. and Canada, and they arrived with no capital, no credit history. Plus, they lacked the specific white-collar credentials that the 1970s American corporate structure demanded.
They were entirely locked out of the traditional economy.
Completely locked out. So they had to analyze the landscape for structural inefficiencies. They needed an industry where they could apply Dhandho, and they found it in the most unglamorous sector imaginable.
Yours was.
Distressed small-town motels.
Okay, distressed motels. We are talking about, what, 10 to 20 room roadside properties? This does not scream infinite upside. It just screams grueling labor.
Right, which is exactly why the traditional operators were failing and precisely where the Patels found their leverage.
Okay, break that down.
Let's look at the mechanics of operating leverage in the hospitality industry. A motel has incredibly high fixed costs, right? The mortgage, property taxes, utilities.
Sure.
But it also has massive variable costs, specifically labor. You need front desk clerks available 24 hours a day, housekeepers, maintenance workers.
Yeah, that adds up fast.
It does. In a normal business model, a 20-room motel might need to charge $25 a night just to cover those massive overhead costs and break even.
Because the moment a guest checks in, the clock starts ticking on payroll. You are bleeding cash to your employees regardless of whether the motel is full or empty.
Exactly. So the Patels identified the structural weakness and completely inverted the model. A Patel family would pool whatever tiny resources they had left, secure a small commercial loan on a distressed, deeply unprofitable motel, and immediately move their entire family into a couple of the vacant rooms.
They were in the motel.
Yeah. And the very next day, they would fire the entire staff.
Wait, every single employee?
Every single one. The entire payroll went to zero.
Oh, wow.
The parents, the grandparents, the children, the family unit became the sole operational engine of the business. They ran the front desk, they scrubbed the toilets, they washed the linens.
So they just took on all the labor.
All of it. Furthermore, their cultural lifestyle was highly insulated and frugal. Their personal cost of living just evaporated because they lived on the property.
Okay, hold on. Let's freeze the frame right here and look at the actual accounting. Because by eliminating payroll and personal rent, they didn't just save money, they fundamentally altered the physics of the business.
Exactly.
Because if the guy down the street requires $25 a night to break even because he has to pay minimum wage and workers' compensation and all that, he cannot drop his price. His floor is set by his overhead.
You've hit the exact mechanism of the Dhandho advantage right there. The Patels lowered their break-even point to the floorboards.
Because their labor cost was effectively zero.
Zero. So they could drop their room rates to $19 a night and still generate a massive profit margin. And in a commodity business like roadside lodging, what happens when you offer the exact same product for 20% less than the entire market?
Well, you capture 100% of the demand. I mean, the budget traveler driving down the highway sees a sign for $25 and a sign for $19. It's an automatic decision.
Good.
The Patel Motel runs at maximum occupancy, while the competitor down the street just sits empty.
And the cash flow explodes. So the Patels take that massive influx of cash, they buy the distressed motel down the street that they just drove into bankruptcy, and they move a cousin in to run it.
Wow.
And they just repeat this process with mechanical precision throughout the 1970s and 80s. And the statistical result is difficult to even comprehend today.
What are the numbers?
Well, today, people of Indian descent make up a little over 1% of the U.S. population. The Patels are a small fraction of that, roughly 0.1%. Yet that 0.1% demographic currently owns and operates over 80% of all motels in the United States.
80%. They monopolized a nationwide industry.
Completely dominated it.
But I want to tie this back to the core mantra. Heads I win, tails I don't lose much. Where is the actual risk mitigation here? Because taking out a commercial loan on a failing property still sounds terrifying to me.
The mitigation is in the structural safety net they build. Yeah. I mean, ask yourself, what is the absolute worst-case scenario here?
The economy crashes and nobody travels.
Right. But if nobody travels, the Patels still have a roof over their heads because they live in the commercial property. They still have food. They cannot be bankrupted by a payroll they do not have.
Ah.
The downside is entirely capped. They survive the winter.
Mhm.
But the upside is swallowing an entire vertical of the American real estate market.
Okay, I see the brilliance in that. It's a masterful manipulation of operating costs. But I can hear a skeptic listening to this and arguing that this is a hyper-specific real estate play from 50 years ago.
Sure. Yeah.
I mean, firing the maids at a roadside motel doesn't really translate to building a massive global brand. You can't exactly bootstrap a technology company or an aerospace giant by sleeping in the lobby.
That is the natural objection, right?
Yeah.
Which is exactly why Pabrai introduces the case study of Sir Richard Branson.
Oh, Richard Branson.
Because this demonstrates that Dhandho is not limited to small-cap real estate. It scales to the absolute highest echelons of global commerce, including, literally, the most capital-intensive, high-barrier-to-entry industry on the planet, which is commercial aviation.
Virgin Atlantic. Yeah, this
Yeah.
is where the concept of capital intensive gets put to the ultimate test.
Absolutely. So Branson decided he wanted to launch an airline. Now, the traditional barrier to entry here is insurmountable for a normal entrepreneur. To start an airline, you need an airplane.
Right.
Specifically, Branson needed a Boeing 747 jumbo jet. And in the 1980s, the list price for that asset was north of $150 million.
Which instantly kills the dream for most people.
Okay.
If you require 9 figures of capital just to open the doors, you are exposing yourself to catastrophic financial risk.
Yeah.
If the airline fails, you are on the hook for $150 million.
Exactly. A traditional entrepreneur would spend 2 years begging venture capitalists and investment banks for the money, giving up all their equity, taking on massive debt.
Yeah, the normal route.
But Branson applied Dhandho. He needed the asset, but he completely refused to take the financial risk.
Right.
He realized he didn't need to actually own the plane. He just needed to control it.
Okay, so what does he do?
He picks up the phone, calls directory assistance in Seattle, and asks to be connected to the main switchboard at the Boeing Corporation.
Wait, he just cold calls the largest aerospace manufacturer on Earth?
Literally cold calls them. He tells the operator he wants to lease a 747, and they hang up on him.
Of course they do.
So he calls back. And the sources note he called approximately 30 times, repeatedly getting hung up on, until finally, out of sheer annoyance, the operator routed him to a senior leasing executive just to get rid of him.
I just want to focus on the psychology of that executive for a second. He's managing billion-dollar international contracts, and he's got this eccentric record producer from London on the phone asking to borrow a plane.
Right. And the executive immediately tries to shut him down. He tells Branson, look, we have a strict policy. We only deal with one flagship carrier per country. In the United Kingdom, that is British Airways. We have no business with you.
Shoot down.
But Branson understands the concept of idle inventory. He says, I understand your policy, but hypothetically, if British Airways called you tomorrow and asked to lease a used, older model 747 that you currently have sitting idle on the tarmac, what would the terms be?
Oh, that's smart. He pros for the inefficiency. He isn't asking for a custom-built, brand-new jet off the assembly line. He's looking for the asset that is currently generating zero yield for Boeing.
Exactly. And the executive admits that, yes, they do have excess inventory sitting idle. So Branson leverages that fact. He negotiates a lease for that specific used aircraft.
But why would Boeing agree to this seemingly absurd arrangement?
Because for Boeing, an idle plane is a liability. It costs them money to park it and maintain it. If Branson defaults on the lease, Boeing simply takes the plane back. Boeing's downside was protected.
Okay, so he secures the physical asset without fronting the $150 million. That's brilliant.
Yeah.
But securing a plane is only step one. How do you fuel it? How do you pay the pilots the landing fees, the marketing? Running an airline burns millions of dollars in operating capital every single week.
Now, this requires a deep dive into the mechanics of the cash conversion cycle and what financial analysts call negative working capital.
Okay, lay it on me.
In most businesses, you buy materials, you build a product, you pay your staff, and then months later you finally sell the product and get your cash back right. You are constantly draining your own bank account to fund operations.
Right.
Branson realized that the commercial airline industry operates in reverse.
Okay, walk me through the exact timeline of the cash flow here.
Sure. When a customer wants to fly to New York for the holidays, they purchase their ticket from Virgin Atlantic 4 months in advance. The travel agent processes the payment, and the cash hits Branson's bank account almost immediately. He now holds the customer's money, but he doesn't have to provide the service for another 120 days.
Wow. So he is effectively receiving an interest-free loan from his own customers.
Precisely. Now look at his expenses. Jet fuel is one of the largest costs. But airlines do not buy fuel in cash on the tarmac. They have vendor contracts with 30-day payment terms.
Oh, I see where this is going.
So the plane flies, burns the fuel, and Branson receives the invoice. He doesn't actually have to pay that invoice until 30 days after the flight lands.
Let me get this straight. He collects the revenue 4 months before the flight and pays the primary operating expense 1 month after the flight.
The gap is 5 months. Furthermore, he structured the Boeing lease so that his monthly payment wasn't due until after the aircraft had completed its scheduled routes.
That is wild.
By manipulating the cash conversion cycle, Branson ensured that he never used a single dollar of his own money to operate the business. The customers funded the entire operation, and the vendors unknowingly provided the credit facility.
Zero starting capital. Zero personal financial risk. I mean, if the airline failed to sell tickets, he just returned the leased plane to Boeing before the fuel bills ever came due.
Exactly. Heads I win, tails I don't lose much. It is financial engineering at its absolute finest.
It completely dismantles the excuse of, I don't have enough money to start. I mean, capital is rarely the bottleneck. The bottleneck is a lack of structural creativity.
Spot on.
Okay, so we have systematically eliminated the financial risk. We know how to structure the math. But this brings up a massive psychological barrier for a lot of us.
Which is?
Well, to build a Virgin Atlantic or to disrupt an industry, you need a lightning strike idea, right? You need to invent something that no one has ever seen before. You need to be the visionary genius staring at a whiteboard.
This is the second great lie of wealth building. The source material presents a paradigm shift that is actually deeply uncomfortable for most ambitious people.
What's the shift?
Originality is not just overrated, it is actively dangerous.
Wait, dangerous?
Yes. If you want to guarantee success, you must become a master of cloning.
Cloning. I mean, it carries such a negative connotation. It sounds like intellectual theft.
It does. We are conditioned from childhood to view cloning as a moral failure. I mean, in school, if you look at your neighbor's test and copy their answers, you are expelled.
Exactly.
Society romanticizes the lone genius inventing a new paradigm in a garage. But the cold, hard data of business success tells a violently different story. The innovator takes 100% of the market validation risk. The cloner takes 0.
Okay, I want to explore that concept of market validation risk. Let's use an analogy. It feels like drafting in a NASCAR race or in competitive cycling.
Okay.
The person in first place is doing all the work, right?
Oh.
They are breaking the wind resistance. They are expending maximum energy to carve a path forward.
Right.
The person in second place just tucks in right behind them, riding in their slipstream. They use 30% less energy, let the leader take all the friction, and then simply slingshot past them right at the finish line.
That is the perfect mechanical metaphor. The innovator has to spend millions of dollars in research and development. They have to educate a confused public on why this new product even needs to exist. They have to make all the catastrophic early mistakes.
They absorb all the friction.
Exactly. The cloner simply waits until the innovator proves that a massive profitable market exists, and then they execute the exact same model with a few minor optimizations.
Wow.
And to prove this, Pabrai points to the two wealthiest entrepreneurs of the modern era, Bill Gates and Sam Walton.
Okay, hold on. Bill Gates is universally heralded as the architect of the personal computing revolution. You are telling me Microsoft is a clone?
Microsoft is the ultimate Me Too operation. Look at their historical product timeline. They did not invent the graphical user interface. They famously cloned it from Apple, who cloned it from Xerox PARS.
Oh, right. I've heard that.
And Microsoft Word, their flagship word processor, that was a direct clone of a dominant competitor called WordPerfect. Microsoft Excel was cloned from Lotus 123. Bing is an overt clone of Google.
That's wild when you list it out like that.
Right.
Yeah.
Everything that has generated massive monopolistic wealth for Microsoft was originally proven by a competitor. Gates just rode in the slipstream and executed better distribution.
So the software industry is built on cloning. But what about physical retail? You mentioned Sam Walton, the founder of Walmart. I mean, the Walton family wealth is staggering. They are collectively richer than almost any individual on the planet.
And Sam Walton, in his own autobiography, openly admitted that he had almost 0 original ideas in his entire life.
Really? 0?
Pretty much. Walmart was initially a direct, unabashed clone of existing discount retailers like Sears and Kmart. Walton saw that the discount retail model worked. and he simply replicated it in rural towns that the big players were ignoring.
But he didn't just copy the macro business model. His obsession with cloning was, like, granular, wasn't it? It was almost pathological.
Oh, he was the most relentless cloner in human history. Walton spent more time inside his competitors' stores than he did in his own corporate headquarters.
Yep.
Yeah. If he was on a family road trip and saw a rival retail chain, he would pull the car over, tell his wife and kids to wait in the parking lot, and wander the aisles with a yellow notepad, aggressively searching for anything he could steal.
He was hunting for the optimizations.
Exactly. The source shares this brilliant anecdote about Walton visiting a severely mismanaged competitor's store alongside one of his own executives.
Okay.
They walk in, and the store is a disaster. The inventory is disorganized, the floors are dirty, the staff is unhelpful. The Walmart executive starts mocking the competitor, pointing out all the operational failures, feeling very arrogant about how much better Walmart is.
Which is the natural human reaction. You look at a failing competitor to validate your own ego.
Right, but Walton stops
Okay.
him and says, yes, their operations are terrible, but did you see their candle display?
Their candle display.
Yeah. He says, the way they cross-merchandise the candles with the seasonal decor is brilliant. Walton ignored the 99 things they did wrong, surgically extracted the one thing they did perfectly, and immediately implemented it across the entire Walmart empire.
That is amazing. And it speaks to the mechanics of retail transparency, too. I mean, if you are trying to clone a software company's proprietary algorithm, you have a massive barrier. The code is hidden behind firewalls and patents. But a retail store is completely naked.
It is entirely open source. You can walk through the front doors of a competitor and instantly reverse engineer their entire business model. You can see their pricing strategy, their supply chain logic, their floor plan, their staffing ratios.
Everything is right there.
Exactly. Walton realized that the market was conducting millions of micro-experiments every single day, and all he had to do was walk the aisles to collect the winning results for free.
Okay, this brings immense psychological relief. I mean, I don't need to put my life savings on the line because I can manipulate operating leverage and cash flow. I don't need to be a solitary genius because I can just draft behind an innovator who has already proven the market demand.
Exactly.
But now we crash headfirst into the most massive, unyielding, practical obstacle for the listener.
Time.
Time. I don't need money and I don't need genius, but I do need to pay my rent this month. I have a mortgage. I have groceries to buy. If I am working 40 to 50 hours a week at a corporate job, my mental bandwidth is completely fried by the time I get home.
That's exhausting.
The idea of starting a business feels impossible without quitting my job. But if I quit my job, I violate the fundamental rule of Dhandho because I'm exposing myself to massive financial ruin if the business fails. How do you square this circle?
This is the exact trap that keeps 99% of intelligent people paralyzed. To break out of it, Pabrai offers a highly structured visual framework for time architecture called the Lego block analogy.
Okay, let's build this out carefully. Imagine a physical pile of Lego blocks.
Right. There are exactly 168 hours in a week. These are your foundational blocks. You cannot buy more of them, and you cannot save them.
Okay, 168 hours.
The first allocation is non-negotiable: sleep. Sleep requires roughly 56 hours a week, represented by 7 8-hour blocks. We do not touch the sleep blocks because sleep deprivation destroys executive function and decision-making.
So sleep is walled off. We are down to 112 hours.
Next, you have your primary income source, your 9-to-5 job. In this framework, these are your blue blocks, 40 hours a week. Now, the standard Silicon Valley advice is to dramatically burn the boats, quit your job, and commit entirely to your startup.
Which is reckless.
It is entirely antithetical to Dhandho. Pabrai's absolute rule is that you must retain your blue blocks. You need that predictable biweekly paycheck to cover your downside risk. As he bluntly puts it, you need some other yo-yo paying your rent while you build your empire.
Okay, so we are keeping the 40-hour job. Where does the startup time actually come from?
It comes from the orange blocks. After sleep and work, you still have 72 hours remaining in the week. Now, a portion of these orange blocks are required for life maintenance, commuting, showering, cooking, paying bills. Let's allocate 4 hours a day during the week and 8 hours a day on the weekend for basic survival.
Right, but that still leaves a massive chunk of discretionary time.
Exactly. You have hours of truly free time that most people default into passive consumption. Watching streaming services, endlessly scrolling social media, going to happy hours with people they merely tolerate.
Ouch. True, though.
The strategy requires a ruthless reallocation. You must convert these passive orange blocks into hyper-focused yellow blocks.
And the yellow blocks are the startup execution time. What is the quantitative commitment here?
You commit to 4 hours of yellow block time every single weeknight and 10 hours a day on both Saturday and Sunday.
Wait, stop. 4 hours of deep work after a full 8-hour corporate shift plus 20 hours over the weekend. I need to push back hard on this. That is 60 hours of intense labor on top of life maintenance. That is not a sustainable framework. That is a fast track to catastrophic burnout, resentment, and a complete collapse of your personal relationships. You cannot sustain that level of output without something breaking.
You are absolutely correct, which is why there are 2 critical mechanisms that must be deployed to prevent that collapse.
Okay, what's the first mechanism?
The first mechanism is highly controversial. It involves fundamentally altering how you engage with your blue blocks, your day job. You keep the job, but you systematically reduce your output to what Pabrai calls just above firing level.
Just above firing level. Wow. You are advocating for premeditated quiet quitting.
Essentially, yes.
But let's look at the practical risk of that. If you suddenly drop your performance from an A-tier employee to a C- employee, management is going to notice. You risk getting terminated, which blows up the entire safety net. You are risking the very income stream that is supposed to protect you.
It requires precise calibration, and Pabrai actually used himself as the test subject for this exact strategy.
Really? How did that go?
Well, before he launched his IT consulting firm, he was a star employee at a tech company. He received top performance reviews, constantly volunteered for extra projects. But the exact day he decided to launch his own company during his yellow blocks, he flipped the switch.
He just turned it off.
Completely. He stopped volunteering. He stopped working late. He delivered exactly what was stated in his job description and not a single molecule more. He conserved all of his premium cognitive energy for his startup.
But surely his managers noticed the sudden drop in ambition. You can't hide that kind of behavioral shift.
They absolutely noticed. For 9 months, he operated in this twilight zone. His bosses were deeply confused. They pulled him into multiple performance reviews, trying to diagnose the problem. They asked if he was unhappy, if he was dealing with personal issues.
But they didn't pull the trigger and fire him.
They couldn't mathematically justify it. He was still executing his core duties adequately. He was hovering perfectly on the line of mediocrity.
That is a dangerous game.
It is, but the payoff for this calibration was extraordinary. After 9 months of funneling all his aggressive energy into his yellow blocks, his IT startup became cash flow positive. The revenue from the startup eclipsed his corporate salary.
So the parachute was finally built.
Yes. He walks into his manager's office, hands in his resignation, and explains that he has spent the last 9 months building a non-competing business that is now fully sustainable.
I imagine they were furious. I mean, he had essentially been coasting on their payroll for almost a year.
This is where the story takes a surreal turn. They weren't angry. They were relieved to finally understand what had happened to their star performer.
Wow.
And then they offered him the ultimate Dhandho safety net. They told him, "We think this startup is a mistake. When it fails, not if, but when it fails, we want you back. We will immediately offer you promotion and a significant salary increase to return."
That breaks my brain. He quiet quit for 9 months, abandoned the company, and their response was to offer him a higher-paying job as a fallback plan.
He achieved the holy grail of risk mitigation. He took a shot at independence, and his worst-case scenario, his punishment for failure, was falling upward into a more lucrative executive position.
Okay, that handles the risk of the day job, but we still haven't addressed the sheer psychological toll of working those 20-hour weekends. You said there were 2 mechanisms. What prevents the burnout during the yellow blocks?
The second mechanism is intrinsic motivation. This architecture will instantly destroy you if you are building a business solely for financial extraction.
Makes sense.
If you decide to drop ship cheap electronics because you watched a YouTube tutorial that promised passive income, you will quit by the 3rd weekend. Working 10 hours on a Saturday on something you hate is torture.
It becomes a second prison.
Precisely. Pabrai insists that the yellow blocks must be dedicated to what he calls your calling, or getting your music out. The work itself must be inherently fascinating to you. It must be a complex puzzle that you genuinely enjoy solving.
So it shouldn't feel like work.
Exactly. For Pabrai, he was obsessed with mathematics, systems, and games. Building his IT sales funnel wasn't labor. It was a thrilling, strategic game. It was vastly more stimulating to him than sitting on a couch watching television.
It has to generate energy rather than consume it. You are trading passive entertainment for active engagement.
Right. If your startup feels like a joyride, the 60 hours vanish. You enter a flow state. The moment it feels like a grinding obligation, you've selected the wrong model to clone.
Okay, the architecture is in place. We have our safety net, we have our cloned idea, and we are happily pouring our weekends into our yellow blocks.
Good.
But now we encounter the reality of the market. I can spend 6 months building what I think is the perfect product in my garage, but how do I know if anyone is actually going to pull out their credit card and buy it?
You don't. In fact, Pabrai operates on the assumption that whatever brilliant idea you have developed in your isolated ivory tower is mathematically guaranteed to be fundamentally wrong.
Guaranteed to be wrong. That is a brutal assessment of entrepreneurial vision.
It is the reality of complex systems. You might have correctly identified 30 or 40% of the market's problem, but you are entirely blind to the nuances of what the customer actually values.
Right.
The danger is that founders fall victim to the sunk cost fallacy. They spend months polishing a product, they fall in love with their own genius, and they refuse to adapt when the market rejects it. To survive, you must embrace rapid prototyping and what we will call the Slide 10 rule.
The Slide 10 rule, this is a masterclass in suppressing your own ego to listen to the market. Set the stage for us.
Right. In the early days of Pabrai's IT consulting firm, he managed to secure a high-stakes pitch meeting with a senior executive at a massive banking institution in Chicago. Pabrai had spent weeks painstakingly crafting a comprehensive PowerPoint presentation. The deck outlined 7 distinct, highly sophisticated IT services his firm could provide.
A massive, sprawling vision of how he could revolutionize their entire tech stack.
Exactly. He walks into the boardroom and begins the presentation. He's moving methodically through the deck. He gets to Slide 10, which details one very specific, narrow service regarding server architecture.
Just one of the 7 services.
Yep. He delivers the pitch for that service and then clicks forward to Slide 11 to continue his grand narrative.
Yep. What does the executive do?
The executive holds up his hand and says, "Stop. Go back to Slide 10.
Just a minor interruption.
So Pabrai thinks. He clicks back, reiterates his points on Slide 10, assumes the executive is satisfied, and tries to advance to Slide 11 again.
Oh, boy.
The executive physically stops him. He says, "Do not change the slide. I have absolutely zero interest in anything else you're talking about. I only care about Slide 10.
He explicitly killed 90% of Pabrai's business plan in one sentence.
The executive didn't care about the comprehensive vision. The bank had a singular bleeding neck problem, and Slide 10 offered the exact tourniquet they needed.
That is so telling.
It is. Pabrai had the extreme emotional intelligence to instantly abandon his own ego. He stopped pitching the other services. He spent the rest of the meeting exclusively discussing Slide 10, and he walked out of that boardroom with a massive, lucrative contract.
But the brilliance isn't just that he closed the deal, it's what he did after he left the building, right?
Exactly. A mediocre founder would have fulfilled that specific contract and then gone to the next meeting and continued pitching the same bloated 7-service deck.
Sticking to the script.
Right. But Pabrai realized that the market had just handed him the ultimate cheat code. If this highly specific server issue was a critical pain point for a massive bank in Chicago, it was statistically probable that it was a massive pain point for every other large corporation in the country.
So he didn't just tweak his presentation, he fundamentally pivoted the entire architecture of his company.
He went home, deleted the other slides, took the concept from Slide 10, and expanded it into a brand new, highly specialized 20-slide deck.
Wow.
He rebuilt his entire corporate identity around that single solution. He transformed a random observation into an empire. But he always emphasizes that his own brain was insufficient to discover that solution. The market had to violently point it out to him.
We get so romantic about our original ideas, but the market is a ruthless editor. You have to put a rough prototype in front of a customer as fast as humanly possible and then have the humility to let them tear it apart.
Absolutely.
But that creates a logistical bottleneck. Having the humility to listen to the bank executive is great, but how did Pabrai, an unknown startup founder working out of his house, get into that Chicago boardroom in the first place?
Ah, that's the real trick.
Right. Corporate executives are surrounded by gatekeepers. You can't just knock on the door.
This is where Pabrai leveraged his obsession with mathematics. He understood that sales is not about charisma. It is a brutal, unyielding exercise in the law of averages.
The law of averages. He didn't have the capital to buy full-page advertisements in industry magazines or hire a sophisticated PR firm. His entire marketing budget consisted of postage stamps and telephone minutes.
So we are talking about cold outreach, but the conversion rate on cold outreach is notoriously microscopic. Most of it goes straight into the shredder.
Which is why you must engineer a mechanism to bypass the physical gatekeepers. Pabrai set a rigid quota. He would send out exactly 200 physical letters every single week to senior IT executives across the country.
200 a week.
But he knew that these executives had executive assistants whose primary function was to intercept and destroy unsolicited mail.
Right. If the envelope looks like a sales pitch, it never reaches the decision-maker's desk.
So Pabrai engaged in a brilliant piece of psychological manipulation. He used an early mail merge software program, but he intentionally sabotaged the formal formatting.
How so?
If he was targeting an executive named David Smith, the letter would not say, "Dear Mr. Smith," it would simply say, "Dear Dave."
Oh, that is incredibly subtle but deeply disruptive to the assistant's protocol. It really is. He would weave the informal name Dave multiple times throughout the body of the letter. When the assistant opened the envelope and scanned the text, the casual tone created an immediate cognitive dissonance.
They don't know who he is.
Exactly. The assistant couldn't verify if Mohnish Pabrai was a random vendor or if he was Dave's old college roommate or golf partner.
And the assistant's risk-reward matrix shifts entirely. I mean, the penalty for throwing away a sales brochure is 0, but the penalty for throwing away a letter from the boss's personal friend is severe. So, to protect themselves, they just place the letter on Dave's desk.
High signal delivery bypassing the noise. But the letter was merely the primer. Exactly 1 week after those 200 letters were mailed, Pabrai would pick up the phone and make 200 cold calls to those exact same executives.
200 cold calls a week. I need to emphasize the sheer psychological endurance required for this. He is facing a tsunami of rejection, hostility, and unreturned voicemails every single day.
It's grueling. Most people view rejection as a personal failure, which is why they quit after 10 calls. Pabrai viewed it purely as a mathematical sorting mechanism. He built an expanding interval funnel.
What does that mean?
If Dave Smith didn't answer or hung up, Dave didn't get removed from the list. Pabrai would schedule another call for 2 weeks later. If that failed, he'd call 4 weeks later, then 8 weeks later.
He essentially stalked them with expanding delays until they capitulated.
A prospect never exited Pabrai's funnel until they either signed a contract or explicitly ordered him to stop contacting them. Because he understood the ultimate statistical truth. If you send 5,000 letters over 25 weeks and follow up relentlessly, a certain percentage of those executives will happen to be experiencing a crisis on the exact day you call.
It's the law of averages. You aren't trying to convince someone who doesn't need your product. You are just taking enough swing so that eventually your bat connects with the ball that was already flying through the strike zone.
That's a great analogy. And to crystallize how powerful this combination of high volume and targeted signaling can be, Pabrai shares a remarkable story about his own daughter.
Oh, this is the hedge fund story, right?
Yeah. She had just graduated from university with a liberal arts degree. She had absolutely no academic background in finance, economics, or business. Yet, she decided she wanted to secure a highly lucrative position at a hedge fund.
Which is crazy because breaking into Wall Street or high finance is notoriously gated. You need an Ivy League finance degree, you need family connections, you need to be recruited out of an elite internship. You don't just walk in with a liberal arts degree and ask for a desk.
Exactly. The front door was triple locked and heavily guarded.
Hmm.
So Pabrai taught her the Slide 10 and Law of Averages framework to find the side window.
What did she do?
He instructed her to build a massive spreadsheet compiling the physical mailing addresses of every single hedge fund operating in New York and Los Angeles.
How many funds are we talking about?
Approximately 1,200 funds.
Wow.
He told her to ignore email entirely because digital inboxes are saturated with thousands of resumes a day. Physical mail forces physical interaction. But crucially, he told her not to send a standard cover letter asking for a job.
Because a cover letter asking for a job is low signal. It demands time without offering value.
Precisely. He told her, you must deliver immediate, undeniable value up front. He instructed her to research one specific publicly traded company, build a highly detailed investment thesis on why that company was undervalued, and attach a 2-page stock pitch directly behind her brief cover letter.
That is the Slide 10 maneuver right there. She isn't pitching her resume. She is pitching a solution to their core problem, which is finding profitable investments.
Exactly. So she prints out 1,200 letters, stuffs the envelopes, and drops them in the mail. And here is where the chaotic beauty of exponential mathematics takes over.
The law of averages kicks in.
Right. You cannot predict which specific seed will sprout. You only know that if you plant 1,200 seeds, a harvest is mathematically inevitable. One of those letters happens to land on the desk of an 85-year-old retired investor in New York.
Wait, his fund was retired? He shouldn't have even been on the active list.
There was a data error in her spreadsheet. But the retired investor opens the physical letter, reads the stock pitch, and is deeply impressed by the analytical rigor. Now, he doesn't have a fund anymore, but he happens to be close friends with a prominent hedge fund manager in Los Angeles named Jamie.
The network effect triggers.
The retired investor picks up the phone, calls his friend Jamie in LA and says, "Are you currently looking to hire a junior analyst? Because I just received this incredibly sharp pitch from a young woman, and you need to look at it."
Because the recommendation came from a trusted peer, it completely bypassed the HR department.
She was flown out for an interview and hired immediately. And her starting salary was significantly higher than the graduates from her university's actual prestigious business school.
That is the absolute validation of the entire system. You clone a proven model, you protect your downside by maintaining your blue blocks, you isolate your slide 10 through rapid prototyping, and you bludgeon the market with the law of averages until the cash flow breaks through the dam.
You have officially transitioned from an employee to a successful, cash-flowing entrepreneur.
Okay, so let's fast forward the timeline a bit. We executed the playbook, we ground through the yellow blocks, we survived the cold calls, and the business scaled.
Right.
We finally sold the company, or maybe we're pulling massive dividends out of it. We have accumulated a significant pile of liquid capital. We have the money. Now, how do we make that money work for us without giving it all back to the market? Because building wealth and preserving wealth require two completely different, almost opposing psychological skill sets.
They are entirely different disciplines. We must now transition from the active, aggressive mindset of the entrepreneur to the passive, highly disciplined mindset of the investor. According to Pabrai, the entire universe of investing can be distilled down to three structural pillars: the starting capital, the rate of return, and the length of the runway.
Starting capital, rate of return, and runway, meaning the amount of time the money is allowed to grow undisturbed.
Correct. And the most profoundly misunderstood secret of wealth creation, the cognitive blind spot that prevents the middle class from becoming wealthy, is that if you can extend the runway long enough, the starting capital becomes mathematically irrelevant.
I need to stop you there because that directly contradicts human intuition. The universal complaint is, I can't invest because I don't have enough money to make it worthwhile. You are saying the size of the snowball doesn't matter, only the length of the hill.
Yes. And to prove how deeply flawed our intuition is, we have to return to that story I opened with, the purchase of Manhattan in 1623. We need to dissect the actual mechanics of exponential compounding.
Let's do it. Walk me through the math of turning $23 into $23 trillion.
To understand the mechanics, we have to introduce a mental shortcut used by every elite investor in the world: the Rule of 72.
The Rule of 72.
Yeah. This is a formula that instantly calculates the velocity of compounding. It tells you exactly how many years it will take for your capital to double in value.
How does the formula work?
It is incredibly simple. You take the number 72 and you divide it by your annual rate of return. The result is the number of years it takes your money to double.
Oh, interesting.
So if you invest in a conservative index fund and expect a historical average return of roughly 7% a year, you divide 72 by 7.
Okay, 72 divided by 7 is approximately 10.
Which means that at a 7% return, your money will double every 10 years.
Got it.
If you are a more aggressive investor and manage to secure a 10% annual return, you divide 72 by 10, which means your money doubles roughly every 7 years.
Okay, the Rule of 72 gives us a predictable doubling cycle. Let's apply that 10-year cycle to the Native Americans' $23 in 1623.
Right. Now, the human brain is designed to think linearly. We think 1, 2, 3, 4. We are not evolved to comprehend exponential growth, which is 1, 2, 4, 8, 16.
Yeah, the curve steepens fast.
So let's trace the math over a century. 100 years contains exactly 10 of these 10-year doubling cycles.
So the initial $23 doubles, and then that new total doubles 10 consecutive times.
Exactly. 2 to the power of 10 is 1,024. For the sake of easy mental math, we will round that down. We can state that at a 7% return, any amount of money will multiply by 1,000 every single century.
It gains 3 zeros every 100 years. Okay, let's track the timeline.
In 1623, The trust officer invests the $23. The runway begins.
100 years pass, we hit 1723.
The initial capital has multiplied by 1,000. It is now worth $23,000.
Okay, $23,000. It's a nice little inheritance, but we certainly aren't buying an island with it. Our lineal brains are looking at this and thinking, 100 years for 20 grand, this is too slow.
Because the curve is still flat. But watch what happens as the snowball gets larger. We advance another century to 1823. The $23,000 doubles 10 more times. It multiplies by 1,000 again.
We add 3 more zeros. It leaps from 23,000 to $23 million.
Now the geometry is changing. We advance to the 3rd century, 1923. The roaring 20s, the 23 million multiplies by 1,000 again.
It is now $23 billion. The growth is becoming violently explosive.
And we advance one final century, arriving at the present day, 2023. We multiply that massive sum of $3 billion by 1,001 last time.
And we arrive at $23 trillion. 23 trillion. I want you, the listener, to physically pause and try to conceptualize that number, because the math is undeniable, but it feels like sorcery.
It really does.
The entire global economy bends the knee to a $23 bill that was simply left alone.
That is the terrifying, beautiful power of the runway. The reason people fail to build wealth is not because they pick the wrong stocks. It's because they interrupt the compounding process.
They pull the money out to buy a car, or they panic during a recession and sell. They reset the clock back to zero.
Exactly.
So what is the actionable framework for the listener? I mean, we obviously do not have 400 years to let our money grow. Our runway is, at best, 40 to 50 years.
The framework requires ruthless simplicity. Step 1. You must artificially manufacture capital by spending less than you earn.
Right.
The rule is to save the first dollar, not the last dollar. If your salary is $50,000, you instantly divert $5,000 into an investment account before you ever see it, and you force your lifestyle to fit into the remaining $45,000.
You pay the compounding engine before you pay your landlord?
Step 2. Maximize whatever runway you have by starting immediately. Every decade you delay costs you a zero at the end of your life.
Oof, that's a good way to frame it.
Step 3. Eliminate the complexity. You do not need to hunt for the next Apple or the next NVIDIA. You simply open a standard brokerage account, purchase a broad S&P 500 index fund, or buy shares in Berkshire Hathaway, and then you do the hardest thing in finance.
Which it?
Absolutely nothing. You set it, you forget it, and you let the rule of 72 execute its mathematical destiny over the decades.
Just buy the top 500 companies in America and go back to focusing your energy on your yellow blocks. That is incredibly liberating. It removes all the anxiety of day trading.
It really does.
But I have to ask, let's say a listener has built a substantial portfolio and they do want to allocate a portion of their capital to picking individual companies. How does a billionaire like Pabrai manage a portfolio of individual stocks without getting wiped out by a bad decision?
That brings us to our final strategic concept, a philosophy Warren Buffett refers to as circling the wagons.
Circling the wagons, okay.
Buffett, who is arguably the greatest capital allocator in history, famously pointed out that over his 60-year career managing Berkshire Hathaway, he evaluated tens of thousands of businesses and made hundreds of investments.
A massive volume of decision-making.
But if you forensically examine his returns, out of all those hundreds of investments, only about 12 specific companies truly move the needle.
Wait, really?
Yeah. 12 decisions generated almost the entirety of his hundreds of billions of dollars in wealth.
Only 12 out of hundreds. That implies a staggering failure rate, or at least a massive rate of mediocrity.
It is the law of averages applied to equity markets. Most companies simply tread water. Buffett conceptualizes this using the analogy of a 20-slot punch card.
How does that work?
He suggests that investors would perform infinitely better if they were given a card with only 20 slots for their entire lifetime. Every time you make an investment, you punch a hole. When you punch the 20th hole, you are legally forbidden from ever investing again.
Wow. That constraint completely changes your psychology. If I only have 20 bullets for my entire life, I'm not going to waste one on some speculative crypto token my neighbor told me about. I'm going to wait for an absolute, undeniable certainty.
You become incredibly selective about what you buy. But the critical insight, the true secret behind those 12 legendary investments that built Berkshire Hathaway, was not the brilliance of identifying them in the first place.
What was it?
The secret was the psychological discipline required to never sell them.
Never selling. that runs counter to everything the financial media preaches. I mean, when a stock goes up 50%, the natural overwhelming urge is to cash out, lock in the profit, and feel like a genius.
And surrendering to that urge is precisely how intelligent people make billion-dollar mistakes.
Mm.
We actually have a perfectly documented, agonizing example of this from Mohnish Pabrai himself.
Oh, no.
He openly shared the story of his most devastating investing error, and surprisingly, it had nothing to do with a company going bankrupt.
Oh, the Ferrari omission. This story is physically painful to listen to. Break down the timeline of the trade.
Around 2012, in the aftermath of the global financial crisis, Pabrai was hunting for distressed, undervalued assets. He analyzed the automotive sector and invested heavily in Fiat Chrysler.
Okay.
The company had just emerged from bankruptcy, they had cleared their catastrophic debt, and the stock was trading at a massive discount to its actual value. He bought a massive, concentrated position.
A classic value investing maneuver. He waited for maximum market pessimism and bought the distressed asset.
And his analysis was flawless. The market eventually recognized the value, the stock price recovered aggressively, and Pabrai generated a massive return. He sold his position and walked away with a few $100 million in sheer profit.
Okay, I am struggling to see the tragedy here. He executed a brilliant thesis and banked hundreds of millions of dollars. By any metric, that is a legendary win.
It is a win until you look at the hidden architecture of what he sold. He missed one crucial detail in his long-term assessment. Deep inside the corporate structure of Fiat Chrysler, they owned an 80% stake in a specific luxury asset, Ferrari.
Oh, man. The most iconic sports car brand on the planet.
Yes. And a few years later, around 2017, the management of Fiat Chrysler made a strategic decision to unlock that hidden value. They spun Ferrari off into its own independent, publicly traded company.
And because Pabrai had sold his Fiat Chrysler stock to lock in his initial profits, he was no longer a shareholder when that spinoff occurred.
Exactly. When he held his massive position, he effectively owned roughly 1% of the entire Ferrari brand. But because he hit the sell button, he forfeited his right to those shares.
Ouch.
Over the subsequent years, Ferrari's market capitalization exploded, reaching nearly $100 billion.
Oh, the math on that is devastating.
Pabrai calculated the exact cost of his impatience. By selling his position to lock in a few $100 million, he missed out on the subsequent explosion of Ferrari's value. That single decision to sell cost him an additional $1 billion in lost profit.
He left $1 billion on the table because he couldn't sit on his hands. He couldn't leave the snowball alone.
He uses this agonizing experience to illustrate a vital distinction between two types of errors: mistakes of commission and mistakes of omission.
Okay, what's the difference?
A mistake of commission is when you make an active bad bet. You buy a terrible company and it goes bankrupt.
You lose your initial capital.
Yes, but the pain is mathematically contained. Your downside is strictly capped at whatever amount you invested. Tails, I don't lose much.
Right.
But a mistake of omission, selling a massive winner too early or missing an obvious opportunity entirely because you were timid, that error has infinite downside. In Pabrai's case, the downside of omission was $1 billion.
So when you finally execute the entire playbook, when you survive the yellow blocks, when you identify your slide 10, when the law of averages delivers you a rare, massive winner, a true multi-bagger that has the potential to compound exponentially over decades, what is the protocol?
You must circle the wagons around it. You build an impenetrable fortress around that asset to protect it from the most dangerous bandit in the financial ecosystem.
And who is the bandit?
You. Your own psychological urges, your ego's desire to tinker, to take profits, to feel like you are actively managing the situation. You have to lock the asset away and lose the key.
So the ultimate paradox of the Dhandho Framework is this. You must have the aggressive, relentless discipline of a maniac when you are trying to find your slide 10, grinding out those 200 cold calls a week. But the moment you find the golden goose, you must instantly adopt the absolute patience of a stone.
Exactly. You work like a predator during the yellow blocks, and you sleep like a rock on the investments.
Wow. This has been a massive architectural shift in how we view risk and time. I mean, we started by dismantling the myth of the heroic, risk-taking entrepreneur. We watched the Patels systematically strip operating costs to zero, creating a floor where they literally could not fail.
We watched Richard Branson manipulate the cash conversion cycle to lease a jumbo jet using his own customers' money.
We absorb the psychological blow that originality is a liability, learning why drafting behind innovators like Microsoft and Walmart is the true path to dominance.
We structured our 168 hours, protecting our blue block safety nets while channeling our obsession into our yellow blocks.
We learn to ruthlessly kill our own egos through the Slide 10 rule, letting the market dictate the product. We bypassed corporate gatekeepers with Dear Dave letters, and we surrendered to the brute force mathematics of the law of averages.
And finally, we respected the terrifying power of the Rule of 72, learning that if we just circle the wagons and let the runway extend, the starting capital ceases to matter.
The frameworks are proven. They are indifferent to your background, your current net worth, or your industry. The mechanics work flawlessly if they are executed. The only variable left in the equation is whether you, the listener, are willing to actually implement them.
And this isn't just theory for billionaires maneuvering capital in skyscrapers. This is a literal, step-by-step playbook for the person sitting in a cubicle right now, staring at a spreadsheet, wondering what they're going to do with their remaining 128 hours this week.
You have the mechanical tools to completely alter the trajectory of your family's generational wealth, starting tonight.
It begins with a single step off the curb.
We spent this entire deep dive dissecting how to find your Slide 10 in the brutal arena of business, the one hyper-specific thing that the market actually values, hidden inside a noisy 20-slide deck of distractions.
Right.
But as we wrap up, I want to leave you with a final, slightly different translation of that concept to explore on your own. What if you ruthlessly applied the Slide 10 rule to the architecture of your personal life?
Ooh, I love that.
If you stripped away all the societal noise, the hobbies you only pretend to enjoy for status, the obligations you actively dread, the passive orange blocks that leave you feeling hollow, what is the Slide 10 of your own happiness? What is the one core truth, your actual internal music, that you should be building the remaining decades of your life around?
That is the ultimate inefficiency worth optimizing.
It truly is. Thank you for joining us on this deep dive. Keep auditing your time, keep looking for the asymmetrical bets, and remember, you do not need to jump out of a plane without a parachute to change the world. The greatest fortunes in history belong to those who simply figured out how to lock in the upside while making absolutely certain they couldn't lose.